Today, we're tackling high-yield dividend funds. We're going to find out what they're actually delivering to investors and, well, it might not be what you're expecting.
So let's just jump right in. Picture this. You see an investment promising a 41% dividend. I mean, that sounds like a sure thing, a no-brainer, right? Well, today we're going to look at some of these super tempting numbers from Roundhill's weekly pay ETFs to figure out if that's, the whole story.
All right, Section 1, the high yield promise. And it's all about chasing those huge numbers. Look, it's easy to see why investors get drawn in by the promise of these giant dividend payouts. I mean, on the surface, if you're just looking at the yield, some of these funds look like they're just unstoppable money-making machines.
And just take a look at these numbers. Seriously, the Tesla fund, TSLW, is posting an absolutely insane 41.37% year-to-date yield. If you're only looking at this one number, this one metric, it's the clear winner, the undisputed champion. But is it really?
Okay, so now we're going to look under the hood. Are there any potential warning signs? A huge dividend is awesome, don't get me wrong, but is that the entire story? The analysis we're digging into today says we've got to look a little deeper. Check the fundamental health of a fund to see if there are any red flags.
And one of the biggest health indicators for any fund is its AUM. That stands for Assets Under Management. Basically, it's the total market value of all the investments the fund is managing for people. And here's the key. If that number starts to drop in a big way, it can be a major warning sign that something's, well, not quite right. And here's a perfect example of what we're talking about. Look at these two popular funds. The MSTW fund saw its AUM drop by over $7 million, while the PLTW fund dropped by $6 million. Now, this could be a sign that they're having to sell off their actual investments just to keep paying out those super high dividends. And that, well, that's just not a sustainable way to do things in the long run. So, okay, this brings us to a huge point. If dividends aren't the whole story, then what is? This leads us to the single most important number, the one metric that really reveals everything. It's the concept that just changes the entire game. And the source material we're looking at puts it perfectly. It says, you're really not doing the true numbers without calculating out your total return. Chasing that big, shiny dividend number without seeing the bigger picture can be super misleading. If you want to know what you've actually made, you absolutely must calculate your total return. So what exactly is total return? Think of it like this. It's the full story. It's not just the dividend cash you get in your pocket. It's that dividend income plus or minus whatever happened to the fund's share price. Did the price go up? Great. Did it go down? Well, that gets subtracted. It's the real bottom line. And the best part is, the formula is super simple. Step 1, you start with the dividend yield you've collected. Step 2, you add or subtract the fund's price change. Did it appreciate or depreciate? And voila, Step 3, the result is your total return. That's the number that tells you what you really walked away with.
All right, time to rank the real winners. This is where it gets really interesting. We're going to take this powerful tool, total return, and apply it to our list of high-yield funds. Let's see how the leaderboard changes. Who's the actual winner when we look at the whole picture?
So, let's go back to our star player, TSLW, the Tesla fund. Remember that massive 41% dividend? The one that looked totally unbeatable? Let's find out what its real return is. Let's run the numbers. Okay, check this out. Here's the breakdown. Yes, investors got that amazing 41.37% dividend yield, but, and this is a big but, at the same time, the fund's share price actually dropped by 20.05%. So that loss from the price going down literally eats away a massive chunk of that dividend gain. And that brings us to the bottom line. TSLW's total return is 21.32%. So the really crucial point here is that the huge 41% number that grabbed all the headlines, it's actually a 21% total return. Now, look, that's still a solid return, for sure, but it's almost half of what the dividend yield by itself was promising. This changes the entire picture. So what happens when we re-rank all the funds using this much more accurate number? Well, the whole leaderboard gets a complete makeover. Our original champ, Tesla, drops all the way down to number 3. And a brand new winner emerges, which completely flips our perspective on which fund was actually the top performer. And the winner is the Hess Fund, ticker HOO, with a winning total return of 39.86%, almost 40%. And what's so interesting is how it got there.
It wasn't by having the biggest, flashiest dividend. No, it was through a much stronger balance of a solid dividend plus real positive growth in its price. That is the winning combination. Okay, so this brings us to your new investment rule, a smarter way to invest. What's the big lesson from all this? It really all boils down to one simple but incredibly powerful rule. So, here are your key takeaways. First, that big headline dividend yield, it's only half the story. Don't fall for it alone. Second, the fund's price change is a huge deal. It can either pour gas on your returns or completely wipe them out. So you just have to, always calculate the total return to know the true score. And finally, remember that a balanced fund with solid growth can absolutely run circles around a high-yield fund that's slowly losing its value.
And that brings us to the final question, and maybe the most important one you can ask yourself. What's the total return on your investments? This whole explainer shows exactly why that's the number that matters most. Don't let yourself get seduced by a big, shiny yield number. Always, always demand the full story.